Hello and good morning. Today's session is on the duty drawback scheme. That exports are necessary and essential for a country's growth is a no-brainer. Having said that, every country aspires to promote its exports by ensuring that taxes are not exported, but only goods are exported. In this background, the duty drawback scheme is one of the most robust and versatile schemes of the Government of India. The scheme has been in existence for a very long time. As the name suggests, drawback seeks to take back all taxes which have gone in the inputs which go in the manufacture of goods which are exported. The definition of drawback itself is available in the duty drawback rules of 2017, which emphasizes the fact that all taxes on inputs, be they imported or produced and manufactured within the country, are to be returned back to the exporter, so that the exporter only exports goods and not taxes, and thus makes his goods more competitive in the international market. The drawback scheme has a statutory backing in the Customs Act. The Customs Act provisions stipulate that drawback will be given. It stipulates that this drawback will be of all taxes which have been used in the manufacture of an exported product. Obviously, the Customs Act will apply only to imported materials and inputs. We also have a provision under Section 37 of the Central Excise Act, whereby taxes of excise which have been used in the inputs which go in the manufacture of an export product are also given back. In the pre-GST era, we used to give all taxes of customs, central excise and services which were consumed in the manufacture of goods which are exported. Obviously, post-GST and with the subsuming of all these taxes, the emphasis of drawback now is only on the customs duties and central excise to the extent of those items which are still in the central excise list. Thus, for instance, petroleum products which are outside the ambit of GST, if consumed or used in the manufacture of any item which is exported and where taxes have been paid, will be returned back in the form of drawback. The drawback scheme, as I had mentioned, is a simple, robust and versatile scheme. The drawback aims primarily at fixing the all-industry rates, which means an average tax incidence which is borne by an item which is manufactured within the country and exported out. So the drawback rules talk of arriving at this averages of taxes, of commodities imported, of items which are used for packaging, of materials which are wasted, and thereafter arriving at a particular rate for a commodity. The process is long drawn, involves intense discussion with the trade and associations. The Government of India normally appoints a high-powered drawback committee. This is currently headed by Mr. G.K. Pillai, the former Commerce Secretary and Home Secretary, and assisted by two senior officers, retired officers of the Government of India, with the Joint Secretary Drawback acting as a secretary to the committee. The committee has detailed interactions with the associations, visits units to see the manufacturing process, and arrives at a rate which is then recommended to the Government of India, which accordingly notifies the rates if it feels the recommendations are in order. The last such notification was issued in December 2018 and it is valid. Typically, the notification has a schedule where the item's description is given, the classification at the 4 and 6 digit is given, the unit is given, the rate which is a percentage normally, and a cap also prescribed. A cap is prescribed only because the drawback is an ad hoc rate and we do not want overvaluation to take place. So the rate being a percentage of the FOB value of the goods which are exported, has to have a cap to ensure that mischievous elements do not overvalue a product in order to claim incorrect drawback. The drawback committee, as I mentioned earlier, is in session almost right through the year, only to ensure that it takes care of the concerns of the exporters, export being a matter of great priority for the Government of India. Currently, more than 3,000 commodities are covered in the drawback schedule, and it is by far the most popular scheme in the export promotion sector. Last year, nearly 24,000 crores was disbursed as drawback. Nearly 60% of all exports were under drawback scheme, and 90% of almost all shipping bills were also covered by the drawback scheme. The shipping bill itself acts as a application for drawback. In other words, there is no separate application required for claiming a drawback. You file a shipping bill for export, you declare the commodity, you declare the classification list of the commodity, and the system thereafter takes care of the fact that this commodity is covered under the drawback scheme and a rate of drawback is mentioned in that scheme and the amount so calculated and credited into your bank account. It is swift, it is transparent, it is extremely efficient. There is little need for interaction with the government or with the customs officials. However, one should, as exporters, ensure that no errors either in the shipping bill or in the EGM, the Export General Manifest, takes place, because this is system driven, and in case of a mismatch between what is mentioned in the shipping bill and what is mentioned in the manifest, the proposal, the shipping bill itself, tends to get rejected. So this is an area where you as professionals should ensure that you advise your clients to take care. Another area, of course, is that all declarations should be correct. You should ensure that there is no overvaluation. As again professionals, you should learn to interact with the drawback committee. Put forth the claim of your particular commodity. Bring forth all the items which go in the manufacture of a particular commodity, the inputs which are imported, the average consumption of these inputs typically in one unit which has to be manufactured, the fuel which is used for generation of captive power, and substantiate your claim with documentary proof. As chartered accountants, you'll be expected to certify to the correctness of all that is being declared by your client. And please remember, you'll be held accountable in case there's any misdeclaration. The drawback committee holds the chartered accountants with great regard and honors such declarations where accompanied with the certification of the chartered accountant. Apart from this scheme, which is an average rate of industry, there may be situations where you feel that you have to get a higher rate of drawback simply because what has been consumed by you is much more than the average arrived at by the committee. In these cases, you can then apply to the Jurisdictional Commissioner of Customs and seek a higher claim specifically for your product. This is known as a brand rate, where the department will carry necessary verifications of your claim, again, which needs to be substantiated with documents, and thereafter fix a rate which will be higher than the all-industry rate, which is, as I mentioned, an average rate. This scheme too is popular in situations where the average rate does not do justice to all the costs which have been incurred by you in the inputs which go in the manufacture of your export product. There is yet another drawback provision in the law. And this is of situations where you have imported a product and paid customs duty on it and are re-exporting that product. In the event of you re-exporting this product within 2 years and where you have not used the product, you get back 98% of the taxes paid at the time of import. You must ensure, however, that these goods are easily identifiable by the customs at the time of export as being the same items which have been imported on which taxes have been paid. Where, however, you have used this product, then there's a sliding scale of such drawback which is given, where it is exported within 3 months, you get 95%, 6 months, 80%, so on and so forth, up to a maximum of 60% if the export takes place within 18 months of the import. So the provisions available are three in effect. One is the all industry rate, which covers almost 90-95% of all situations. The other is the brand rate, where in specific situations you feel you require to have a greater amount of drawback. And third is the situation where imported goods are exported either without use or after use. So the drawback scheme places on you no requirements other than being honest in your declarations. But please remember, it is an export promotion scheme, which means the Government of India would like you also to ensure the proceeds are realized. We would like you to export your goods and bring the money which you so earn into the country. Where you do not bring your proceeds into the country, then the government can take action to recover the drawback which has been given to you. So, typically the drawback is given immediately after export on the basis of your shipping bill, and if your foreign exchange is not realized within the timelines prescribed by the RBI, which is 6 months to 1 year, or extendable again by RBI in specific situations, then the government can take steps to recover drawback. The laws are very stringent. This recovery of drawback is along with interest, and this also attracts the provisions of Section 135 and 104 of the Customs Act, which is prosecution and arrest. Therefore, please ensure that not only you declare correctly, but you also realize the proceeds of such exports and bring them back into the country. The drawback scheme, like I mentioned, has been popular also because it has withstood WTO scrutiny. Please remember the WTO frowns on any subsidies which are given on products which are meant to be exported. This has withstood all such scrutiny simply because the government has consistently been able to substantiate the fact that what is being given is only the taxes which have been suffered by the inputs which go in the manufacture of the export product. There has not been any situation where this has faced challenge, though proceedings have been initiated but subsequently stopped because they could never substantiate the allegation that the government has been giving more than what is due. This scheme continues now, and I think will continue for a long, long time. You as professionals, you as exporters ought to make use of this scheme. It is simple, it is transparent, it is swift, it is efficient, and involves little or no interaction with the government, which in these days should be a wonderful thing.